All right, let's dive right into this explainer. If you've spent any time looking at market data, you know that finding a genuine, repeatable edge is incredibly difficult. Honestly, most perfect backtests you see out there are basically just financial fiction. So today we're unpacking a fascinating research audit trail called the SRBMPR structural backtest methodology. Now, to be clear right up front, this isn't a sales pitch for some magic trading algorithm or a live execution system. It's a strict, discretionary free framework designed for one specific purpose: extracting pure market behavior from BTC/USDT. Let's see how it actually works. We've structured this journey into 6 quick stops. We'll start with the backtesting illusion, move through the SRMBPR philosophy and market structure extraction, tackle look-ahead bias, confront the nested data problem, and finally look at moving toward true validation.
Okay, section 1, the backtesting illusion, and why most financial backtests completely fail when they meet reality.
So how do we actually trust a backtest in markets that are just overflowing with noise? It's a massive problem. In statistical research, a very common and, frankly, lazy flaw is p-hacking. Basically, testing dozens of parameters and only reporting that one lucky trial that produced a massive return. It gives this illusion of a brilliant discovery when really it's just curve-fitting to past noise. We absolutely love to cheat ourselves with these perfect models. But to fix this, we have to entirely rethink how we define market movement in the first place. And that brings us to the core of this framework. The creator, Syed Rahman Gulabwadi Abushit, operates on one brutal truth: the market only moves by contact. Think about that. If a price level hasn't been physically touched by the raw data, it simply isn't valid yet. This forces us to look strictly at reality, rather than what an arbitrary smoothing indicator hopes is going to happen next. Moving on to Section 2, the SRBMPR philosophy. This is all about observation before prediction. You see, most retail systems take price, run it through a formula like a moving average, look for a crossover, and try to predict the future. SRBMPR completely throws that out. Instead, it starts with absolute data integrity. We're talking about using uncleaned, user-provided, raw OHLC data exactly as exported. There is zero filtering, no gap filling, and absolutely no outlier removal. It moves strictly to observing raw structural relationships entirely free of human discretion. The goal here is to measure what the structure actually did, not guess what it will do. This philosophy requires strictly separating the known historical context from the totally unknown future. The left side is the price history that is already formed, the market memory used to confirm a pivot. The right side is the action occurring after that pivot, which is a complete mystery until it physically prints on the chart. You just cannot evaluate a sequence independently from its origin. Separating the chart this way completely changes how you view historical patterns. So, let's get into Section 3, extracting market structure, and follow the actual journey of a raw BTC/USDT data point. The reproducible Python pipeline executes 3 strict steps. First, it loads that raw tab-separated data. We're talking date, time, open, high, low, close, tick volume, and spread, used exactly as provided. Next, it runs a zigzag-style alternating pivot detector. And finally, it groups those pivots into cycles based on structural breaks. It's the raw, unfiltered truth of the market. Now, here is the absolute linchpin of the whole system: 0.1%. This was chosen from a set of options, 0.1, 0.3, 0.5, or 1%, to act as the single fixed parameter for a minimum reversal threshold. A pivot is only confirmed the exact moment price reverses by at least 0.1% away from a running extreme. And because this is percentage-based, not based on fixed price levels, it's completely scale invariant. The math works identically whether Bitcoin is trading at $10,000 or $100,000. Once those pivots are found, they get grouped in 2 cycles using standard break of structure rules. An upcycle originates at a low and continues as long as every new high is a higher high. It dies the exact moment a lower low forms. That lower low then becomes the origin of a new down cycle, which continues on lower lows and only ends when a higher high breaks the prior structure. It's binary, it's mathematical, and it completely removes human emotion from reading the chart. All right, Section 4, removing look-ahead bias through strict mechanical rules and locked parameters. Look-ahead bias is arguably the deadliest sin in algorithmic design. It's essentially the mistake of letting an algorithm act on pricing data it shouldn't mathematically know yet. For instance, if a backtest enters a trade exactly at the absolute lowest tick of a crash, it's cheating. In real time, you literally don't know it's the lowest tick until the price has already bounced off it and confirmed the reversal. To mathematically neutralize this bias, the SRBMPR methodology uses locked parameters to force an entry lag. Remember that 0.1% reversal threshold? Well, the system triggers a long entry at the origin point of a cycle, but it calculates a realistic entry price using a strict formula. The origin price multiplied by 1 plus 0.1%. It simulates a live scenario where you must wait for the price level to actually confirm the pivot before entering. You literally cannot enter at a price you couldn't have identified in real time. This massive distinction grounds the entire backtest in reality.
Let's look at Section 5, the nested data problem. This is where we honestly evaluate the limitations of the BTC/USDT datasets used in this study.
Here we have 4 specific datasets that were evaluated, ranging from 1-minute to 15-minute timeframes. Dataset A covers about 73 days, while Dataset C covers roughly 2.3 years from March 2024 to July 2026. The exact same raw OHLC format and 0.1% rule set was applied across all of them. But if you look closely at the timelines, a glaring issue with statistical independence pops up. The critical observation here is that Dataset A's 73-day window sits entirely inside Dataset B's 1-year window, which itself sits almost entirely inside datasets C and D. What this means is we are largely looking at the exact same underlying Bitcoin price history, just through different magnifying glasses. Because they heavily overlap, they are not truly independent market regimes. And that leads us perfectly into our final section, Section 6, moving toward true validation and what the next phase of this research actually looks like. Because of that nested data problem we just talked about, this audit report clearly states that these results are preliminary. To prove this structural rhythm edge beyond a shadow of a doubt, future research has to apply these exact locked parameters to distinct, non-overlapping historical windows. Think testing 2022 only, and then completely separately testing 2024. You have to take this identical 0.1% pivot logic and apply it to Forex or equities without tweaking a single parameter to fit the asset, all while maintaining that completely discretionary free process. The SRBPR methodology gives us a fascinating, highly disciplined lens to view market memory. By forcing a model to wait for absolute price contact and building in that realistic entry lag, it strips away the fantasy of perfect backtests. The groundwork is absolutely laid here, and the logic is rock solid. So I'll leave you with this final thought. What do you think happens when we unleash these strict, observation-first rules onto completely untouched, multi-asset data next?